So I want to do a talk about sector rotation with PerfCharts and BPIs. Sector rotation is something that we've done at StockCharts since actually the very beginning of the website. It's a lot of what Tom sprinkles into his commentary and Erin sprinkles into her commentary. John Murphy was the first person that I read that went into this in great detail with his intermarket analysis. But the goal of sector rotation is important to keep in mind. And it's also, I'm going to show you a picture here that hopefully you can, when you hear Tom or Erin talking about the relationship between sectors, this picture will come into your mind and it might become clearer. Ultimately, the goal of sector rotation, however, is to find out, are there any big forces that are moving the market right now? And the answer to that sometimes is yes, and sometimes is no. And most of the time is, it depends, and partially yes and partially no, and that kind of thing. So the question is really, how can we visualize those big forces? And what should we look at to see them? So first question is, where do we get the data? It says, we still use the 9 S&P sector ETFs because of the large amount of historical data that we have. So that's a decision we made back at the very beginning of the website. Ultimately, is 2 years ago now, a year and a half ago, Standard & Poor's changed the number of sector ETFs that they were using to track sectors from 9 to 10. And we want to move to that 10 sector model. We will be moving to that 10 sector model soon, but we're waiting for more data to accumulate so that our sector rotation charts don't become overly short. And you'll see that when I show them. But it's the question is, where do we get this? So these ETFs are very, very useful. You'll see Tom, he was already showing them earlier today. You'll see Erin talking about them as well. This is the XLK, the XLP, the various S&P sector spider ETFs. And so we think they're very, very good as proxies for what's going on in the individual sectors. Now, the rotation work that we do is based on a model developed by Sam Stovall and mentioned by John Murphy in his books, The Sector Rotation Model. So let me take half a second and show you that model. This is the picture that I want people to have in their heads when you hear the term sector rotation and you think about it. So what are we showing here? Well, first off, what's important to understand is that all other things being equal, there is a order to how sectors should outperform the market. And the reason for that order has to do with the underlying business cycle, which is shown here as a green curve that goes up and down, and then it repeats. As you go off the left side of this chart, you come back on the right side. So that's just a cycle. The business cycle exists, and the point is that the market tries to anticipate the business cycle. So the red line shows what the market is doing, and it shows, for instance, the red line peaks before the green line peaks. And again, that is to indicate, based on, again, on Sam Stovall's work, that the market generally will precede the business cycle. And because that's what everybody on Wall Street is trying to do, is to predict the business cycle. And they actually can do a reasonable job of it. So as, for instance, we get into a early recovery phase of the business cycle and towards a full recovery phase, the market itself is already peaking. And in fact, the market will start to decline just before the economy itself, the business cycle, hits its top, its peak. So given that, and the other assumption of this picture is that all phases of this cycle are the same duration. This again is a model. This isn't reality. It shows everything happening kind of in an equal time frame. As we'll see, that doesn't occur. But if it did, then you would see things like cyclicals peaking, and then technology would peak as investors became more anticipating the upturn in the market. They get more excited about more risky stocks like technology. Then the economy itself starts to pick up and industrials do well. The theory being that factories and other kinds of manufacturers will start to invest, and they'll start to do better. That in turn will lead to a demand in materials. That in turn will lead to a demand in energy. Energy typically is the stock, although combined with a little materials and a little consumer staples, these are the sectors that will be doing very, very well at the peak of a market. Over time, however, the market will start to fade, and that's when the defensive sectors start to take over. So the sectors here on this side of energy, to the left of energy, might be called the offensive sectors or the bullish sectors. And the sectors to the right, consumer staples, healthcare, utilities, financials, are more defensive in nature, especially consumer staples. So consumer staples is kind of the opposite of cyclicals, which is consumer discretionary is another name for cyclicals. And so you see those are kind of at opposite ends of the cycle. In addition, utilities is essentially if utilities are doing well, that means the bond market is doing well. If the bond market is doing well, that means that the people are not happy with stocks. So technology is kind of the opposite. Technology industrials are kind of the opposite of utilities. If people are excited about stocks, they're going to be in these sectors, and if they're not excited about stocks, they're going to be in utilities because they're really in bonds. Financials, similar situation. They do well when the bond market's doing well. However, again, an uptick in financials might be the first thing we look for, and then hope as we do sector rotation to see upticks in cyclicals, followed by what we're really going for, upticks in technologies. Technologies generally lead a strong rally. So anyway, that's the model that we want you to keep in mind as we go through this stuff. So how can we look at where we are now and what the actual data is? Well, we've come up with a tool that we try to use to visualize this. It's called PerfCharts. It's by no means a perfect tool, and sector rotation in general is not a perfect science. There is a lot of interpretation involved. But PerfCharts show performance changes over time for several symbols overlaid on top of each other. On the left side of every PerfChart, everything starts at 0, and on the right side, it will be the percent change over the course of the chart will be what's displayed. We have an interactive PerfChart tool, which I'll demo in just a second. It can be found under the free tools area. It can also be found in the members workbench. We have links to it in several different places. When you pull up the tool, however, as I'll show, you want to select the S&P sector PerfChart, and then you'll get the full display that I'm about to give you. There is a slider below the chart that controls this time span and makes it interactive. And as I mentioned, this S&P sector choice, if you choose that from the predefined PerfCharts, then you'll see all these sectors. And not only that, but we will switch over to histogram mode, which shows you the ending percentages, which is the most important thing for sector rotation. So, and then I'm going to do my demo in just a minute, but I wanted to tell you both parts of the demo before I do it. In addition to the PerfChart demo, after that, I want to confirm anything that I think I'm seeing on PerfCharts by looking at our bullish percent indexes. We also provide bullish percent indexes for each of those 9 S&P sectors. And a BPI is the percentage of stocks within a group, in this case within a sector, that have bullish point and figure charts. So point and figure charts, I showed that a long time ago, the X's and the O's. Computers can very easily determine if a P&F chart is bullish or bearish. And so they can look at all of the P&F charts in a group and quickly come up with the percentage of those charts that are bullish or bearish. And the bullish percent is what is in the BPI. The BPI is a market indicator, meaning that it is a ticker symbol. It's not a technical indicator that you select from a drop-down. Instead, you type in a ticker symbol. They're all going to start with $BP. And so we have different BPs for each of the sectors that we're going to go over. We also have them for markets and other kinds of things, but I'm going to focus on the sector BPIs. And the best way to look at those are using our candle glance page, and that's what I'm going to show once I'm finished. With that, let's get to the demos. Here is a PerfChart, S&P Sector ETF PerfChart. And again, you can get to that from the free tools page. You can also get to it if you're a member logged in over here under the Extra Control Center. The first thing you do is you click on PerfCharts. And then the next thing your standard chart looks like, with the lines going all the way from 0 over on the left to whatever the percentage that they end up with on the right. Use the slider to move back and forth through time, and you can drag the edges of the slider just to change the duration, the start and the end date. So PerfCharts are very useful in and of themselves for a variety of things, not just sector rotation. But if you want to do sector rotation, you're going to go to predefined groups and you're going to select S&P sector ETFs. When you do that, we're going to give you this page, which is a special version of our PerfChart page. And again, I've automatically changed it from line mode to histogram mode. In histogram mode, we're just taking the final values that you see here on the right side of the chart and turning them into histogram bars here on our chart. And you'll notice we order these histogram bars in the same order that our S&P sector model was in Sam Stovall's model. I included a picture of the model down below here. Cyclicals, technology, industrials, materials. That's what we have here. And so now we can start to look at 4 sector rotation effects. The first thing we have to decide is what duration do we want to use. By default, it has a 200-day duration on our perf chart. We can, as I mentioned, we can drag the slider, the edges of the slider left and right to change that. We can also, this is very important, we can also right-click in the middle of the slider and then select a predefined duration. And for sector rotation, there's several different choices depending on if you're looking for short-term effects or longer-term effects. I always like the 3-month, or at least to start with the 3-month duration. It gives me a good overview of what might be happening. I can then choose to shorten that or lengthen it, depending again on what I'm interested in finding. Now, what I wanted to point out is when we're doing sector rotation effects, we're looking to see, are there clusters of up positive sectors that are joined together, or are there clusters of down negative sectors? And if so, does that give us an indication that there might be sector rotation occurring? In this particular case, right now, right off the bat, I would say this is the kind of chart we don't want to see when we're looking for sector rotation effects. They may be going on, but there may be something else that's obscuring it. In other words, what we're seeing here is we're seeing up and then down, and then up and then down, and then up and then down. We want to see something more where there's a lot of stocks that are up over here maybe, and a lot of stocks that are down over here. So clusters of up and downs. Now, the good news is if I just go back a little bit, and I'm going to start to go back, the way I'm going back, by the way, is I'm pressing my left arrow key on my keyboard. You press the left arrow key on the keyboard, it takes you back just one day. And that allows you to very quickly kind of move to a specific date. And so look at this. What we've got here, remember that the chart circles around. So what we got here now is we have 1, 2, 3, 4 sectors that are positive, and then we have 1, 2, 3, 4, 5 sectors that are negative. So that's a nice kind of sector rotation effect. It's not too long ago. That was mid-April when this chart happened. I can actually even make this effect more obvious by right-click. I'm right-clicking on the chart here with my mouse. That's a right-click. And then I can do show cycle line. So right-click show cycle line gives me a visual tool, this yellow line, that I can now click and drag to just move around on the chart. It's just a visual aid for looking for these kinds of things. And so notice as I move this line kind of right about here, I would say the majority of the histogram bars fall underneath the yellow line. They fall between the yellow line and the zero, the horizontal zero line. And so that kind of indicates where this cycle might be. And so then I'm interested in, okay, where is the top? The top in this case is right at the end of financials, the beginning of cyclicals. And if I was able to see this effect exist for a while, then I would be very, very interested in that, because in this case, it would mean the market might be trying to move from a defensive posture over here into a more bullish and offensive posture. Again, technology is leading, cyclicals doing well. These two doing okay and starting to fade. That indicates that we might be at the beginning or trying to get to the beginning of a bearish part of the cycle. The other thing is we see weakness in the stocks that do very well at the top of an economic cycle. So this particular chart is just 3 months, and it was again ending in the middle of April. Was indicating some very positive things about the market and about the economy. We could go further. We could right-click and select, for instance, the past 6 months, and then we would look to see if we had confirmation of what we thought we saw in April. We may or may not. Part of that depends on the market's memory, and part of it depends on if there was anything else that was affecting things. Here we go. So I've just, with this particular chart, ending towards the beginning of April, I see again weakness in the middle to bearish part of the sectors, and I see some strength in the bullish side of the sectors. Now, It's always good. So as you can see, sector rotation is not a exact science. There's a lot of interpretation involved. Whenever that's the case, you want to try and get confirmation of what you think you see. And as I mentioned, another way to get confirmation is to go and use our sector BPIs. So I'm going to go back to the members dashboard, or I could go to free tools, and I'm going to come down here and find our candle glance tool. So candle glance allows us to see several charts all together, all at once. And they're mini charts, and they fit very nicely on the screen. And so we have several predefined groups of candle glance charts. So I've scrolled down to the bottom. There's a button here called predefined groups. And you'll see that one of the predefined groups is sector bullish percent indexes. So I'm going to select that one. And then I'm going to make sure, I always make sure that I see these in 3x3 in a 3x3 display. So I resize my screen just to make sure that everything is in a nice. And so these are also in the order that we're interested in, with consumer discretionary, in other words, cyclicals, starting here, then techs, then industrials, then materials, then energy, which should be good, doing good at the top of an economic cycle, staples, healthcare, utilities, and finance. And so what I'm looking for here is a couple of things. First off, I'm very interested actually in the scales on the right side of these. The ones that we automatically scale these charts, and you can get fooled. It can look like a sector's doing really well when in fact it's very close to the bottom of its chart. In this case, we see the consumer discretionary, the cyclicals, starting to improve. The short term, the blue line is the short term moving average, starting to improve. However, the long term is still flat to down. We see technology stocks starting to improve, although again, the longer term moving average is flat to down. We definitely see industrials still going down heavily and getting to the bottom of their BPI range. BPIs again go from 0 to 100. Materials aren't too impressive. Energy has been going on a big run, and that is still looking very impressive from a BPI perspective. Staples down, or moving down, and going down right now. The BPI numbers, by the way, are updated at the end of each day. And so these are charts as of yesterday. They don't include today's information, because we have to run the calculations, and we only do that after the market closes. Ultimately, though, we can see utilities are also in a big uptrend on these charts. Everything else is kind of flat. So we have energy and utilities doing very well on the BPI charts. And so that kind of contradicts my theory, my hope, that things were starting to turn around. I would say at this point, the BPI charts are not confirming that particular interpretation. My goal here is just, again, to remind you that, or to show you how to use the tools, to show you how they can be used, and to remind you that you want to try and get confirmation whenever you have something that's so subjective. So hopefully that will help. Again, Tom and Aaron, they talk all the time about how if staples are doing well, that means discretionary and cyclicals are not doing well. Now, hopefully you'll be able to use that picture in your mind, and it'll start to make even more sense. With that, I'm going to wrap it up. I have a link if you want some additional information. Here's the link that we put together. This will just take you to our article on sector rotation in the chart school area of the site. So with that, anybody questions, or?
Were there any questions in the chat room, Aaron? You might be muted there, Aaron.
Yeah, there's a few. Of course, some are, usually, Chip, when you come in here, it's always requests for something. Can you do this? Can you make it do that? The one thing somebody did ask, though, is how, can you use RRG charts along with this for confirmations?
That's a great question. First off, I love to hear all the suggestions people have for how we can make our site better. I'm all for that. Please keep those coming in. In these kind of sessions, obviously, I'm focused on a particular topic, but I still read all that stuff later. Second off, yes, RRG charts are an absolutely awesome additional way to confirm or maybe look at this sector rotation stuff in a different light. I still suggest, though, that the Sam Stovall model might help you, even when you're looking at an RRG chart, keep everything straight in terms of if this sector is doing well, then we hope the next sector would do well. That would show strong sector rotation effect.
All righty. Let's see what else. That was kind of the main ones. I know, when you were looking at those BPI charts, somebody said it would be nice if they all went from 0 to 100%, but I'm thinking really what you're looking for is just which direction they're moving.
Yep.
Okay. Let's see. Anything else? No, I think the rest we've either answered or covered. So.
Well, terrific. Just keep sector rotation in mind. It's something that you probably don't need to review every day. I would review it like maybe once a month or so. And I think it'll give you a higher level perspective about where the market's at and where it might be going.
Yeah, I would just add too, Chip. I mean, you mentioned and credited John Murphy as being the first person that you've read who, really got into a lot of this rotation and looking at different areas of the market and how certain areas are performing versus other areas. I did the same thing. John Murphy, I give John Murphy a lot of credit. I read his books. I do follow sector rotation very closely, and anybody who follows the show knows that I will talk about that XLY versus XLP ratio. To me, that's the most important ratio in the market. And you were showing it, in terms of, you were showing it visually on that wave, that cycle chart earlier, where you've got consumer discretionary or cyclicals on one side and you've got consumer staples on the other. And I think that relationship is probably, I don't know if it's the most important, but it's certainly one of the most important, because when you think about our GDP, 2/3 of it is consumer spending, and where that money is being spent in which areas, whether it's consumer discretionary, which are the things that we want, or consumer staples, which are the things that we need. I think the relationship there is incredibly important. And I thought that chart that you showed early on really ties that together, and why you want to kind of look at those two to see which is leading. Because if you pull up an XLY to XLP ratio chart, which is XLY colon XLP, and then you also drop the S&P 500 in a separate window below or even behind that chart, what you're going to see is that the two tend to mirror each other. So for instance, when the consumer discretionary starts to underperform the consumer staple space and the S&P 500 keeps going up, to me, that's a warning sign. You want to really be careful, because the market underneath the surface is starting to rotate in a fashion that normally is not bullish, even though if you're looking at the S&P 500, everything seems fine. You're going to hear all the cheerleading on CNBC, but it really is more important what's going on underneath that surface. I just wanted to kind of follow up and talk a little bit about that, because I thought that was a great point.
Yes, no, I agree. Again, those are at opposite ends of the cycle. And frankly, you could look at other sector pairs that are kind of at opposite ends of the cycle. I think those are the two strongest ones and the most important ones to look at. But some of the other pairs can also be interesting. But thank you. You also reminded me one other thing that I want to point out before I go, which is this particular chart. Not only does it automatically go into histogram mode for you if you select the S&P sector ETFs, it also uses the S&P 500 as a baseline. What that means is that these percentages you see here are the percentages above or below the performance of the S&P 500. This doesn't mean the technology on an absolute basis over the past 200 days is up 10.4%. It means it's up 10.4% above what the S&P 500 did. So see how I've got the S&P 500 box here clicked in gray? If I unclick it, now those are absolute percentages, but clicking it, this is the relative percentages, essentially above how they performed above or below the S&P. And that's super important for sector rotation. You want to make sure you're not looking at the absolute performance of the sectors, you're looking at how they did relative to the market as a whole. So Thanks for reminding me of that.
Yep, and then that slider down at the bottom, if you shorten that from 200 days down, you can obviously start to see, you can begin to see in the short term, is that relationship changing, which is really important.
Okay, well, I'll leave it to you guys to do the rest of the show. How's that sound?
Sounds good. Have a great weekend, Chip, and thanks for stopping by.
The Chart Watchers newsletter features expert technical commentary about the current market from some of the industry's leading technical analysts. See what's really happening in the markets through their eyes and gain an edge in your own investing. The newsletter is packed full of insightful and educational articles intended to help you become a better investor. Whether you are brand new to charting or a seasoned technical analyst, each edition will provide a wealth of informative content. It's the best way to stay informed on all the latest news, events, updates, and additions here at StockCharts.com. Whether it's a new feature or blog, an upcoming conference, or a special sale, you'll hear it first in the Chart Watchers newsletter.
This is a brief tutorial on using stochastics. Big word, but wonderfully simple. The idea behind stochastics indicator is that as the price moves up, the close tends to stay close to the highs, or the price action throughout the day tends to stay close to the highs. And as the trend weakens, it has trouble staying near the highs. The stochastics will point this out. And the reverse is true at the lows. So as price is declining, all of a sudden it stops always closing near the lows. So not to get confused with %D, %K, %R, that type of thing, Henry Ford started with the Model A and went B, C, D, E, F, G, all the way through to T until he came out with the Model T Success. And so when George Lane and his colleagues were doing that for stochastics, they kept working their way through, and they did the same thing. They used %A, %B, %D to try and find a rhythm that worked out nicely. So what stochastics does is it takes a range over the last few days. In this case, a 5-period stochastics would say that from this point to this point is 100% and price closed at 82%. And then that would be %K, and then %D would be a moving average of that. And it's important to remember on stochastics, according to George Lane, there is only one valid signal, and that is the divergence on %D. So you're looking for the divergence on moving average, and I'll show you that on some real live examples. So here's Apple, and I've got these stochastics set up slightly different. So this is a fast stochastic, this is a slow stochastic, and you can see that it's much smoother. It's got these whipsaws taken out, and that smoothing function is what %D is changing for us. And then the full stochastics here, I've changed the period to 14 instead of a 5-period stochastic, just to show you that it gives you smoother signals, and so it's a little easier to trade with a 14 period, and that would be the default at StockCharts. But depending on how aggressive you want to be, you might find that there's a better way to trade. So all of these signals are important, but what the big clue you're looking for here is this positive divergence where things are improving while the momentum is coming down, and you're starting to see the stock whipping around at the bottom here, usually a sign that something's getting a little more volatile and you might get a chance. So a nice trade like this would be a great move of $30 or something like that, and it would have got you in relatively early. Here is USO, and what we want to show you on this particular area is you can see how the price is actually struggling to make any moves higher. And even though %K keeps banging on the top here, the %D, which is the moving average, this purple area, is moving down and making a lower high here. And it's that lower high that is our divergent clue that we want to be aware of. And then that's going to give us our sell signal. And in this case, we've got double divergence with another lower high way over here. And that is a real clear signal that George Lane likes to talk about. When you get those, it's a very valuable signal. So you're looking for the divergence on the moving average. And again, in this case, I've set up all three as 5 period moving average, but our default is 14, so you could set them up whatever way you'd like. And the way you do that is just select them from the drop down menu in here, and then pick the time period that you want.